how taxes in the US are different for a dental practice owner from an employed dentist.
When you are a dental practice owner, you need to know what your profit is. You need to have a set of books. What strategy do I want to focus on? Anything that is ordinary and necessary to conduct your business is tax deductible. For example, you need dental supplies. Okay, you need computers to run your business. You need to pay your staff.
So, can poor expense tracking increase a dentist's tax liability?
If you don't track your expenses well and you don't keep a proper set of books where you're recording each and every expense you've had for your business, then you lose that deduction.
Hey DJ, welcome back to another podcast.
Thank you.
How are you today?
So far, so good.
Our last conversation was mind-blowing because I, who had no idea about taxes in the US, came to know about so much things that a dentist should know about. So, in this podcast also, I believe that I can ask you better questions. But before we start, I would like you to introduce yourself and your business to our audience first.
Sure. Well, I'm glad you enjoyed the last session, and I've been doing this for a decent amount of time. I'd say 13 years. We work with a lot of dentists. I feel like we about 90 dental practices we do bookkeeping for. We have a lot of dentists who own multiple dental practices. We do a lot of tax projections, a lot of tax planning, a lot of tax coaching. We answer a lot of tax questions related to the business dentistry and how things should work.
Okay.
So I'm in Texas. There's a city called Round Rock. It's just north of Austin. So that's where we're at. It's not a big office. Right now we have a team of about 3 people and growing. We've been there for a good amount of time, I think 6 or 8 years.
Okay.
Yeah, and all our work is done in Round Rock, Texas. From a bookkeeping and tax standpoint, everything is done in that office.
So, to start simple, I would ask that how taxes in the US are different for a dental practice owner from an employed dentist.
Those are two very different situations. When you're an employee, there's not much you can do. At the end of the year, you get a W-2 from your employer. It tells you how much money you made, how much did we withhold from your W-2 and your paychecks. And then you have that, you plug the 4 numbers in your tax software and you're good to go. Typically, there's not much you can do over there, okay? When you are a dental practice owner, there's a lot of stuff that is there. You need to know what your profit is, and to get that, you need to have a set of books. And then there's a lot of opportunity. You need to look at, okay, hey, what do I want to do from a tax planning standpoint? What strategies do I want to focus on? So you look at those strategies, and then you bake those into your business while you're running your business, and you get to take advantage of those. So they're very different tax returns. If we get calls from a dentist who's just an employee, we don't even do their tax return. Like we're not the best fit because we're just too niched into dental practice ownership, and that's what we want to work with.
Okay, so what are the main types of taxes that a dental practice owner must be aware of?
There's a lot of them. Let's put it that way. To keep it simple, there's so many of them, and sometimes I appreciate the ingenuity of all these various tax entities, how they want to tax dentists and their constituents to a certain extent. But let's start from the top, from the federal side.
Let's categorize it.
Yeah. So from the top, everybody knows the federal income tax. Okay, that's something everybody knows and everybody pays. But then come the payroll taxes. Again, starting from the federal side, you got to pay Social Security, you got to pay Medicare taxes. So those are the 2 other types of taxes. Now, if you're a business owner, what happens is you not only pay the employee's side of the Social Security and Medicare, but you pay the employer's side as well. So they can get that tax can get pretty expensive.
Okay.
You might end up paying some taxes on the state level if your state taxes. If your state is one of those income taxing states, then yes, you pay state income taxes. You might pay state income taxes at the individual level, and you might pay state income taxes at the business level as well. So it just depends what state you're in and what the rules are over there. We are in the state of Texas, and most of the tax returns we do are for the state of Texas, where there's no state income tax per se. However, the state of Texas has franchise tax, okay, which is on the top line revenue. So there's that. So franchise tax, and other states have similar taxes as well. So that's one type of tax. Then what happens is you have something called a business personal property tax, which your local county where your dental practice is at, they will send you a tax bill for that. So there's several types of taxes that you pay, but those are the main ones that you have for dental practice owners.
Okay, so now if we talk about a higher level, how does the money earned by a dental practitioner is actually taxed?
So a dental practice owner is taxed on the profits they have for the business. Okay, that's what they're taxed at. Now, some dental practice owners think, hey, if the money is still in the business, I'm not taking that money out. So that's not going to be taxed because I never took the money out personally. However, that's not the case.
Okay.
In most dental practice situations, the business itself is not going to pay any taxes. Most of these entities are pass-through entities. And what happens is any income you have at the business level is going to be taxed on your individual tax return. Okay, if you're a Schedule C, you actually report the P&L of the dental practice on your individual tax return. This is Schedule C. If you're a disregarded entity, then the P&L is typically reported on your individual tax return on a Schedule C, and that's how you get taxed. If you are an S corp, if your business entity is an S corp, what happens is you file a separate 1120S S corp tax return, and then the income is reported over there. And then what happens is you, as the owner of the business, get a K1, and that K1 is reported on your individual tax return. Okay, so the business tax return itself is not paying any taxes. That income is reported on your individual tax return, and that's where you pay your taxes.
Okay.
Keep in mind that's how planning is done as well. That okay, the business is not paying any taxes. You as an individual are paying taxes.
Okay, so can we say that the profit that you draw is different from the actual profit you make?
I believe what you mean by the profit you draw is the cash you take out of the business is different from the profit you actually have. Yes, it certainly is. What we call the cash you take out is typically distributions. When you take out money from your business as a business owner, that is distributions. Okay. Now, if it's running through payroll, that's W-2 income. But if you're just taking it out without running it through payroll, it's just simple distributions. And that is different than what profits you make. Profit is essentially, okay, you had $1 million in collections, and then you have employee expenses and all the expenses that you have. And then you come up with, okay, what is your profit? And that's what you get taxed on, not the actual cash you take home.
So how should a dentist pay themselves as a business owner?
Well, how a dentist pays themselves as a business owner changes depending on the entity structure.
Okay.
If you're just a PLLC and you're a disregarded entity, when you pay yourself, you just essentially write yourself a check.
Okay.
Dr. Joe Smith, $50,000, and you say on the memo, you say withdrawals or distributions, and that's it. You get paid. If you're a S corp, or if your entity is set up as an S corp, then it changes a little bit. Then you have to pay yourself a reasonable salary. That's number one that you have to pay yourself, and that runs through payroll, just like you run it for other employees. If you have a reasonable salary, whatever that might be, you run that through payroll, and then payroll company does its thing. It will report that salary on the W-2, deduct payroll taxes from that, just like other employees, and deduct federal income tax from there, and then it will send you a net check. So that's one way you get paid. And then the other way you get paid is distributions. So just like disregarded entity, you're writing a withdrawal check. For the S corp as well, you will write yourself a withdrawal check saying, okay, hey, Dr. Joe Smith, $20,000. In the memo, you write distributions, and that's how you get paid. So there are two ways you get paid as an S corp. and one way when you are a disregarded entity.
So you have mentioned two terms here. One is salary and one is distribution. So how is owner salary different from owner distribution, and how does it matter when it comes to taxes?
What happens is that when you get paid a salary, okay, that is a deduction for the business. Okay, so as an S corp, when you're getting paid a salary, on the tax return is reported owner compensation, and there's a very specific line for it. Okay, so you report that over there. That way, the IRS knows that as the owner, you got paid a salary, and that's where it's reported. It's a deduction over there. But when you file your individual tax return, so what happens is that is reported as a deduction on the S corp, and then that W-2 that you received from your S corp is reported on your individual tax return as W-2 income. You will see that, okay, hey, I got a certain amount of salary, and that's what is getting reported. So that's how that piece of works out. Distributions are essentially not taxed.
Okay.
Unless you over distribute and you may take distributions over your shareholder basis. Okay. So you have to be careful about how much distributions you're taking, because what happens in an S corp scenario is it can block you from taking certain deductions that you might have in the S corp, or sometimes it may end up in additional capital gain taxes due to excess distributions. Now, these are very technical terms. I think you need to talk to your accountant and keep an eye on what your shareholder basis is. And based on that, you have to figure out, okay, hey, how much money can I take out, and so on and so forth.
So I believe this is the right time to ask this question, that what are the common mistakes that business owners make while paying themselves?
Well, I think what we've noticed sometimes is like, how much salary do you pay yourself? That is a key benefit of being an S corp. What we've noticed is sometimes it's really, really low.
Okay.
And sometimes it's really, really high, where there's no benefit to being an S corp. You have to have a balance where it's not too low, the salary you're paying yourself, but it's not too high either, where it eats up all your profits. There's some careful planning that goes into that. Okay. Now, let me tell you the consequences of paying too low. Okay. If you pay yourself too low of a salary, Uncle Sam can come back and recharacterize some of your distributions that you've taken, which were tax free from any payroll taxes, and recharacterize them as wages.
Okay.
When they do that, essentially now it's subject to payroll taxes. So let's say they come and recharacterize $100,000, just to keep the numbers simple. Now you owe $15,000 as payroll taxes on that. Now, if it's been 3 years since you were supposed to make those payments and you haven't done that, they're going to charge you penalties and interest on that $15,000 in taxes. That can be a pretty penny. So you need to make sure you are paying yourself a reasonable salary. So that's the low part. Okay, if you pay it too low.
Too low.
The high part is that when you pay yourself too much in salary, again, the payroll taxes that you paid is overpaid. You paid too much.
Okay.
Let's say you paid yourself a salary of $400,000, okay? But you could have given yourself a salary of $150,000, okay, and still be reasonable. That means you paid payroll taxes on about $250,000 that you really did not need to pay, okay? That can be a pretty penny. So you have to figure it out how that works out for your specific situation, keeping in mind the QBI deduction as well, okay? So not only you need to pay payroll taxes on that additional amount, okay? Or not only did you lose the additional payroll taxes you paid on that $250,000, but now the QBI deduction you would have received on that $250,000, you do not receive that either, because QBI deduction is calculated on profit. And if you zero out your profit by giving yourself $400,000 in salary, then what happens is you don't get QBI deduction. There are specific scenarios where you have to pay that salary because your specific state might have some taxes that are due on an S corp profit, and that's why your accountant told you to go ahead and pay yourself a big salary and have no profit. But in states where there are no state income tax, typically you want to keep it low enough to where
Okay.
you're reasonable, but you're not paying yourself too much.
So what type of expenses are typically tax deductible?
From a dental practice standpoint, or generally speaking, anything that is ordinary and necessary to conduct your business is tax deductible. Okay. So any expenses you're having for the business that you need to have to run your practice or enhance your practice, all those are tax deductible. Okay. For example, you need dental supplies. Okay. You need computers to run your business. You need to pay your staff. If you are driving your car to go get supplies or you're going on CE, you need to do that. Okay. So all those expenses are tax deductible. Now, you do need to keep documentation
Right.
for these expenses, but all these are tax deductible. If you buy a computer to run your business from home and that's the majority of the job that you're doing with that computer, it is tax deductible. So you just need to figure out, okay, what is ordinary and necessary for your business? Those are tax deductible. Now, some dentists think that, hey, if I'm just going out to lunch by myself, I am essentially nourishing my body so that I can work. That should be tax deductible. Unfortunately, not.
Okay.
If I'm getting a massage for myself so that I can work as a dentist, because it's a hard job. Okay. And I agree with the fact that you do need massage, but unfortunately, that's a personal expense. So if you're doing something just for yourself, a lot of times, those expenses are not tax deductible.
Because people often assume that everything they are spending on is tax deductible.
I wish that were the case. I really do. It would have been a nicer life. Would have more fun with this stuff, but it's not. Uncle Sam makes it a little bit harder to take those deductions. So, but you start to do things a little bit different. It's going to cost you money, but if you start to have, if you're going out for lunch and you're going out for lunch with a staff member, and you're paying for the lunch for you and your staff, both of them, and you're discussing business, that's what it's about, then it's tax deductible.
Okay.
If you are going on a retreat where the whole team gets massages, it's tax deductible because now it's a team event, and that part becomes deductible. The question becomes cost benefit analysis. Okay. And Uncle Sam knows that. Okay. If you're getting the massage for everybody, then it's going to be more expensive to get the massages than the tax benefit out of it.
Right.
So they know that you're not going to do that all the time. So they're okay with that.
So how do depreciations and equipment purchases works from a tax perspective?
So let me explain the concept of depreciation first. Okay. Because I think let's clear that term. It's not something most dentists learn in college or while going to school. So let's talk about that for a second before I get into how the taxation and deduction part works. So when you buy certain things for your office, which are going to last you for a while, okay, and they're not disposable like gloves or burrs or something like that, what happens is, let's say your dental chair. You're going to buy a dental chair, and that dental chair is going to last you for a good 10, 15 years a lot of times.
Right.
If you buy a couch for the office or furniture for the office, that's going to last for a while. So when you buy those things, they're not direct deductions, okay? You have to capitalize them. You have to show them on the balance sheet, showing that you purchase these items, you purchase dental equipment, you purchase furniture, or you did leasehold improvements, okay? You have to show that, okay, that's what you purchased, and those things are going to last for a while. Then Uncle Sam says that, okay, hey, we have very specific lives for these specific items, and then you can take the deduction for these things via depreciation over the lives of these assets. So for example, dental equipment can be depreciated over 5 years. Okay. So let's say you bought a $50,000 equipment. So every year, if you do the straight line method, it's $10,000 each 5 years. That's what you get the deduction for. However, there's a number of ways you can take depreciation. There's several of them. If you want to take an immediate depreciation, you can also take Section 179. So you can depreciate the $50,000 in the year you actually purchase the equipment as well. Okay. You can do that and take that deduction to reduce your taxes. Right now, we still have bonus depreciation, 100% bonus depreciation. You could do that. There's also maker's depreciation where you start off high and then it starts to go down. So there's a bunch of options. Now, so that's how it works out. Some CPAs suggest buying equipment to get the deduction, or some dentists think, let me just buy equipment to, take the deduction to reduce my taxes. What we recommend is think about it from a profit standpoint, usefulness standpoint, financial standpoint first, then the tax standpoint.
Okay.
If you're going to buy a $50,000 worth of equipment, it needs to do at least one of the three things. It needs to make you either faster, either it needs to allow you to do new procedures,
right,
hence make more money, or it needs to make the patient experience a lot better. Hence, one of these things which will help you make more money. If it's not doing that and you're just buying the equipment to get a deduction, that's not the best way to think about it. Keep in mind, even if you're at the highest tax bracket of 37%, which is the highest tax bracket right now, if you spend $100,000, you are only getting $37,000 of a benefit from a tax standpoint. You still spend, that the other 63 is gone. So if you don't need that equipment, why lose the other 63? Just pay the 37, keep the 63. So you want to make sure you're thinking about it from a financial standpoint instead of just strictly tax standpoint.
So can poor expense tracking increase a dentist's tax liability?
Yeah, for sure. If you don't track your expenses well and you don't keep a proper set of books where you're recording each and every expense you've had for your business, then you lose that deduction. If you lose the deduction, that means your profits are higher than what they should be. And then if the profits are higher, you end up paying more tax on those profits. So you want to track each and every expense. You want to make sure you track them as per accounting and IRS rules, and they're reported in the proper period and reported in the proper years. You want to make sure you do that. Where we notice where people miss expenses is that either they paid some expense from their personal account and they never told their accountant that we did that.
Okay.
They just didn't tell them. Accountants don't know till you actually tell them, right? So that's one place. Or what we've had in the past, like long time ago, or where we've seen is that, okay, hey, the business owner went out and got a big old loan to buy some equipment, and they don't tell their accountant that, okay, we got this loan to buy this equipment, and they don't start making the payments like 6 months later on, and the accountant doesn't catch it because they have not been told. And so they just do the taxes based on what they had, and they miss that expense. So yeah, improper tracking of expenses will almost certainly increase your taxes.
So how is the profit different from the actual cash in the bank?
So I see where you're coming from. What's the difference between the two? Okay. We get this question quite a bit. Okay. Hey, you're telling me I made $400,000 profit. I don't see that in my bank.
Right.
And I'm like, yeah, I understand. And then we try to explain to our clients how things work. Profits do not mean cash flow. Okay. And what you see on your P&L as a profit, but that's not the only thing that you're using your money for. Okay. You're using your money for paying off loans. You're using your money for distributions. So anything that's reported on the balance sheet is not on P&L, and hence it doesn't affect the profit and loss statement.
Okay.
So the profit is very different from what cash you have in the bank. Okay. So what we do is that we provide a report called "Where did my cash go?" to our clients when they get in this situation and they're not sure where the cash went. The typical report you get from accountants and the typical cash flow report you get from accountants is an indirect report. Okay. And it's really hard to explain, it's really hard to understand. So we built our own report where we start with how much cash you had, where how much money you brought in from a collection standpoint, and then we show you, okay, you spent so much money in employees, so much money on facilities costs, and so on and so forth. Then we show you, okay, you had certain expenses specifically to you as a shareholder. So you will see your salary over there. You will see your related party salary over there. You will also see the distributions you've taken. So you'll see your total that actually went to your pocket. Okay, paying expenses for you, meaning your payroll taxes, your health insurance. And then we show you, okay, how much the cash went up or down. And then we show you, okay, where's the cash at? So that report kind of helps bridge the gap between, hey, I see so much in profits, but I'm not seeing the in cash flow. What happened to my cash? So that explains the scenarios a lot better.
Okay, so since you are talking about the reports, how does a proper bookkeeping impact the tax paid by a dentist?
What a CPA typically does is takes the reports from the bookkeeper and prepares the tax return.
Okay.
A lot of CPAs, depending on the detail they're going to go through, are going to check the reports for reasonability. They're not going transaction by transaction. They're typically not asking a whole lot of additional questions. They're just looking at the reports. Does it look reasonable? Does it have a proper balance? If it's supposed to be a debit balance, is it a debit balance? If it's supposed to be a credit balance, is it a credit balance? That's the extent that they go through, and then they're like, okay, if it looks reasonable, we're going to prepare the tax return and move on.
Okay.
If you had recently taken a loan at the end of the year and you didn't tell your bookkeeper that, and your bookkeeper didn't put it on the QuickBooks or whatever accounting software you use, the accountant's not going to do that. They just move on with what you have provided. Just keep in mind, bookkeeping is the foundation of pretty much anything you do from a business standpoint. Okay. When you're making business decisions, you look at your bookkeeping report to figure out, okay, how much am I spending on payroll? How much am I spending on dental supplies? How much am I spending on advertising? If those books are not right and things are not being categorized correctly, you're at a loss. And sometimes it's not even categorized incorrectly. Sometimes it's just not done. Okay. Keep in mind, you do need to do your bookkeeping regardless. That needs to be done so that you can file a proper tax return. So you need to do that. Why not do it year-round on a monthly basis so that you can make use of it to make better business decisions and also get better tax advice and file a proper tax return?
So do you think being extra conservative always safer from a tax standpoint?
It might be safer, but it's not worth it.
Okay.
You're overpaying in taxes. There's no reason to give Uncle Sam more money than you need to give. There's really no reason to do that. What you do need to do is make sure you have the right documentation, you understand the tax law, and you take advantage of those tax laws that Uncle Sam already provides to you. Okay. We go through about 13, 14 strategies that are for dentists, and we coach our clients on and make sure they understand them, make sure they understand the risks if there are any, and then they take advantage of those deductions. So safe is good, but it can be expensive. So we'd rather have you take the deduction and reduce your taxes with the proper documentation.
So DJ, once again, thank you so much for this wonderful conversation, for this highly informative podcast. I believe that I have learned a lot today, and I hope the same is with the audience. But still, if in any case they have any query, they can comment down and we'll try to cover their queries in our upcoming podcast. So once again, thank you so much for coming, sir.
Thank you.